All right, here we are. Welcome to my webinar. I'm Mike Delparty, live from New Zealand, beautiful New Zealand, here in what is this, day 10, day 10 of our 14-day managed isolation in quarantine, which means we stay in a hotel room for 2 weeks. It's going great so far, New Zealand, and the folks here are wonderful. I don't have a New Zealand accent yet, so sorry about that. But yeah, good morning and good afternoon. Thanks for calling in from around the world. Given the fact that I'm just kind of sitting around in a hotel room with not much to do, I thought, hey, what a great time to jump in and do another webinar, and kind of share with you some of the stuff that I've been thinking about and what's happening in different real estate markets around the world. So let me share my screen here, and really what I'm going to do today is cover off two things. One is general market dynamics of what I'm seeing happening, and this is really all about supply and demand. And the second is more of the disruptors, iBuyers, and what the big players, these big multi-billion-dollar companies, are doing in this space. So lots of graphs. Will be about, I don't know, 30 minutes or so. I've got 45, 50 slides, so you know what to expect. But I'm not going to take questions, but feel free to shoot out afterwards. Reach out to me on LinkedIn or email or anything like that if you have any thoughts, and I'll get back to you if I can. So jumping into the market dynamics here, as I mentioned, it's all the thing that I think about. I'm not. This may come as a surprise to those that don't know me, but I'm not a classically trained economist. I don't really even know what an economist does. I'm a data guy, and I look at a lot of data. And when I look at the data, this is what I think about right now. I think about supply and demand. If you're asking these questions, what's going to happen to this market, this country, this city, this region, this state, anything, and you think about you think what's going to happen to the real estate market, it really all comes to supply and demand, and it's different everywhere. So basically, if we start out with the U.S. market, I think about supply and demand two ways. One is supply, is new listings coming to market. And we can see, so this data, this is tracked from Redfin, and it's nationally. It's not just Redfin data, but it's all the markets, all the markets they're in. It's a really good representation of the U.S. market in general. So the red line is 2020, and this shows year over year what's happened. You see, of course, this incredible dip in new listing volumes when the pandemic hit, and then it's slowly starting to build back up. It's not at the levels it was last year nationally in the U.S. So supply is still low. And really we have this giant gap here. These are listings that just never came to the market, right? It hasn't rebounded. If it was a normal year, they would have come to the market, but they didn't. And that's this big dearth of supply, this lack of supply. Second, if we go to pending sales, which I think is a great corollary for demand, right? This is not people on a website looking around. This is not somebody filling out a form online. This isn't even somebody getting pre-approved for a mortgage. I think the highest intent measure of demand is actually somebody putting a contract in, an offer in on a house and having that accepted, right? So that's pending sales. And again, if we look nationally in the US, you see a similar trend, right? Quite a big drop during the first months of the pandemic, but a strong rise. And actually, we're back up to, the US is back up to where we were about this time last year. So that's rebounded. But if you kind of take those two together, demand is greater than supply. And this kind of matches up with the commentary you might hear in the market, or you read in some media press releases or whatnot. Buyer demand in the U.S. is huge right now, and it's outstripping the available supply. And what happens when that happens is this: inventory goes down. So again, Redfin data looking at active listings. You can look at this data from a lot of different sources, but nationally, if you look at the active listings, the amount of inventory in the market, it's going down. And it's going down at a time when it's supposed to be going up. So if you just look at the red line, it's kind of a small dip here, but keep in mind the past 2 years, it's gone up quite a bit. So active inventory, active listings down probably 30% year on year. That's huge. That's a huge decline. It's a huge decline. So I thought I'd dive into a couple specific markets to kind of show this in action, right? So Austin, Texas is a great market example where demand is very clearly outstripping supply. So we'll look at the same chart. So new listings in Austin, right? We see the same thing, right? A dip and then a recovery, not quite to where we were last year at this time, but it's back up there. If we look at pending sales, you see this, right? A dip And then this is I don't know, a rebound, a recovery. I mean, huge amounts of demand, right? The pending sales in Austin are up 20, 30%, 40% from last year. And you can see that right here. So demand is clearly outstripping supply in a major, major way. So if you look at, I haven't looked at house prices in Austin, but I've heard from some folks on the ground. I mean, they're going up, right? This is what happens when inventory is down, supply is down, and there's a lot of demand, house prices go up. And also what happens is the inventory goes down. I mean, I don't think you can call the shape of this curve anything but precipitous. It's just going straight down. This is inventory, right? This is active listings in the Austin market. It's going straight down. Look at another market, Pittsburgh, Pennsylvania. This is a good example of a market where the supply is outstripping demand. So same, let's look at the new listings. New listings, I mean, this is just a beautiful graph right here, right? You see the drop and then it's kind of recovered right about to the right level. It's up a little bit, which is kind of what you'd expect because there's all these new listings that just never came to the market. You'd expect them to come to the market at some point, and here they are. So good amount of supply coming to the market. Demand is recovering nicely, but it's clearly not at the levels it was last year. You know, it's still down kind of 20%. So supply is outstripping demand, and when you have that, the inventory rises. So again, number of active listings, the inventory in the market is going up. I'd say Pittsburgh probably resembles more of a healthy market than Austin. Austin's clearly out of balance. Pittsburgh is still recovering, and these are kind of, you know, graphs you would expect, right? New listings back to normal levels, pending sales kind of coming back up. We'll see what happens there. And naturally, right now the inventory is rising after a dip, but it's probably not going to, you know, keep going up, right? There'll be a limit to that at some point. I got this in my email the other day from a realtor in the Twin Cities area, and, you know, I kind of circled these things down here, right? I mean, this is what you see time and time again in a lot of markets. New listings down 15% from last year. Active listings, inventory down 30% from last year. These are really, really big numbers, right? Those are big drops. And you know, you can kind of think about the market in a couple different ways. The places people want to be and the places people don't want to be. And you hear about people moving out of the cities, and, you know, that's true to some degree. If you look at the New York City market, inventory is going way up because supply is outstripping demand. You look at markets like Austin, Seattle, some other Texas markets, Denver. Those are markets people want to be. They're moving in there, and demand is outstripping supply. And it's not just outsized demand. I would say supply is constrained. You know, supply, the number of new listings coming to market is lower than you would expect. It's lower than it should be. It's lower than it was at this time last year. So I'm in New Zealand. Auckland is New Zealand's biggest market here, and that's where I am right now. So I had a chance to look at some of the data here from the largest broker in the area, Barfoot and Thompson. So thanks for sharing that. But wanted to show some of this, kind of a market where demand does equal supply. It's not an imbalance. So if we look at Auckland year over year, you see new listings, you know, went down during the pandemic, have rebounded strong, and have kind of done what you've expected, right? If there's a lack of listings for a period of time, and they're going to come to the market, they're going to come when the market opens back up. And that's what's happening here in June. And into July actually as well, where those numbers are much higher than they were last year. It's all this pent up supply kind of finally coming to market. So supply is rebounded. If we look at demand in terms of sales, actual sales, this is pretty close to a true V-shaped recovery here, right? It went down and it's back up, and it's back up to the level it was last year. So that supply and demand, neither one of them seem to be in balance or out of balance. And the result out of that is you get that active inventory, you know, the amount of active listings, the amount of inventory, it's the same, you know, it's kind of flat. It hasn't really dropped at all. And that's a reflection of a, you know, relatively healthy market where you have, or a healthy marketplace. Obviously there's going to be mixes in supply and demand, but if supply and demand are relatively matched, there's as many buyers as there are sellers. So the big question that I kind of keep asking myself, and I think everybody should ask, is in your market, is supply increasing faster than demand? What's happening, right? What's happening in that space? That's going to affect everything. That's going to affect house prices. It's going to affect, you know, new construction. Everything is going to come down to that. I can't go through every single market right now, but Redfin, Zillow, there's a number of places that have data available. You can go in, type in your market, and kind of see what's happening. So that's a bit of a market update. Now I'm going to go to disruptors. Um, and when I think disruptors, I'm thinking, the big US-based iBuyers, the multi-billion-dollar companies, whether it's Zillow, Opendoor, not scrappy startups. These are large companies that have invested hundreds and hundreds of millions of dollars into new business model to disrupt real estate and change the way people buy and sell houses. So there's kind of three themes when I think about these that I think about here. One is these companies need to survive the pandemic. They need to simply get through it. And we've seen that happen over the past couple months, right? Where the iBuyers stopped buying houses. Layoffs have occurred, right? This is about cash conservation. This is about making sure there's enough runway to survive this. The second is this path to profitability. And I'll get to this more later. And the third is this further integration with the traditional industry and disruptors, kind of no longer being an either or, but more of an and statement. So there's been a lot of interesting moves occurring over the past month. And that's what I'm going to talk about here. So just to recap, iBuyers, market share from 2018 to 2019 went from 0.25% to 0.5%. So this is by no means what I'd say mainstream, still very small, very niche in terms of the US market. 0.5% market share, though, is still quite big. I mean, that's tens and tens of thousands of transactions every year. These are the markets, kind of pre-pandemic where the iBuying activity, iBuyers were, kind of your Sun Belt, good housing markets, a lot of activity, consistent housing stock, with the exception of Minneapolis and maybe Salt Lake and Denver, nothing serious in the way of winters. So that's where the activity is. Now, if we look at what's happened, right? So if you remember kind of back in, March, April, the iBuyers paused purchasing houses. They said, all right, the world is a bit too risky right now. We're just going to stop buying houses. It's not safe. We don't really know how to value a house. We're not sure what's going to happen. So this is the impact of that. This is showing total number of national iBuyer purchases. That's with the, the big four, Zillow, Opendoor, OfferPad, and Redfin. And yeah, you kind of see what happened here, right? A huge dip, kind of down 90% in terms of those purchase volumes in April, May, and June. We're starting to see a little rebound in June, not much, but a little one. Keep in mind, these purchases, this is based on when the transaction hits the public property records. So there can be a bit of a delay in all this, but this is accurate. This is in terms of the houses they've taken under contract in those months. Now, in terms of the recovery, I don't know what the next 6 months are going to look like, but if you assumed a line like that, for instance, that could, that's what 2020 could look like. If that was the case, total iBuyer purchases for the year would be down 50% from last year. So I'm not saying that's what's going to happen. It's probably most likely, but I don't know if that's what's going to happen or not. I don't know if things will speed up, if they'll slow down. But if this is important to you and you're thinking about iBuyers and market share and whatnot, there's a baseline, right? This is where we were, this is where we might be. And if that's the case, total volumes could be down 50%. But that doesn't mean they've stopped selling houses. So again, this is looking at the total number of iBuyer sales, so the sales transaction volume year over year. You can see kind of in the beginning of 2020, I mean, really strong sales. I think that was in general just folks trying to clear their inventory. But even when they stopped buying and said, all right, everything's too risky, we're kind of done here, we're going to hold, they still kept selling houses. And they still kept selling, at a pretty good clip, kind of obviously down from last year, but still selling thousands of homes a month. So getting rid of that inventory. The thing to keep in mind, though, is this is April, May, June. This is when they stopped buying, right? That's when things are down 90%. Once they buy a home, then they fix it up and they sell it. Average hold time is kind of around 90 days, 3 months. So this iBuyer sales chart, you're really going to see it get anemic, July, August, September, kind of Q3 of this year. Why? Because there's no house, like they haven't bought any houses. There's not going to be any houses to sell. And this is important to keep in mind, I mean, for a number of reasons, but, it's when they sell a home that the business cycle completes and they kind of book the revenue off that sale. So things are going to get ugly here before they get better. So who's with those big four iBuyers, who's kind of accelerating, and who's buying more than the others? This shows the past 3 months, the total number of iBuyer purchases for those top four iBuyers I mentioned, right? So if you look at kind of Open Door as an example, in April they bought over 300 houses, and that's dropped to about 100 houses in each of May and June. So what's interesting out of this? I mean, a couple things. Right now, OfferPad, bought the most houses in June, so they've kind of re-accelerated the quickest. Open Door, huge drop, a bit more conservative in that re-acceleration. Redfin's, I mean, not even on the scoreboard here, and Zillow, again, even more conservative approach. So you'll read the press releases and you say, oh yeah, we're back in the market, we're in these markets, we're buying houses, everything's back to normal. That's true. But if you look at the actual numbers and the volume and the evidence behind that, everybody's kind of back to it in varying degrees, different momentum. And again, it's still kind of early days, so we're going to see what happens here. But if you just kind of, if we just, for instance, right now, benchmarked against Zillow, and we said Zillow is kind of 1x, right? If buying 50 houses a month is the baseline, Open Door's buying twice that, so they bought twice that in June. OfferPad's buying 3 times that amount. And then Redfin's just at nothing quite yet. So they're moving at different speeds. And then the other question I wanted to ask is where, what markets are kind of picking up? So the 5 biggest iBuyer markets, if we look at iBuyer purchases so far over the past 6 months, are Arizona, primarily Phoenix, Texas, that'd be kind of Dallas and Houston, Atlanta, Georgia, you got Raleigh and Charlotte, North Carolina, and then Las Vegas. You can see what happens to the iBuyer purchase volumes. So just take Arizona here as an example. Quite strong before the pandemic. Pandemic hits, dropped right down there. Starting to see an uptick, right? So Phoenix is the biggest market. It was, and it still is. Texas starting to see a little bit of an uptick. Same in Atlanta, same in North Carolina. Nevada, I mean, just teeny tiny there, but we are seeing an increase. So these are the markets where they're buying the most houses again. And you can see it's not back to normal. It's clearly not back to normal. It's not even half of normal. It's not even a third of normal. It's kind of 20% of normal at this place, which is, hey, it's a place to start. But the last thing on that I wanted to highlight, this really struck out at me. The markets themselves are recovering faster than the iBuyers. And I think this is important to keep in mind. So what I mean by that is purchase activity and sales, total sales in a market have recovered relatively quick. But the iBuyers are lower than that. So a way to illustrate that is just market share. So I've looked at Phoenix, and this is the purchase market share. And you can see all the iBuyers went from kind of, between 4 and 5% pre-pandemic to just about 1% of that purchase volume. So I hope that's clear, but you can imagine, there's this big dip. If we go back here, this big dip in Arizona, in Phoenix, right? In terms of the purchases, this is not what the overall market looked like, right? The overall market in Phoenix did not go down 75%, and it's not still down 75%. It went down a little bit and it rebounded quite quickly. And if you look at the total number of sales in Phoenix in June, I think it's basically the same. It was at the same level as it was in February or March. So it's back up there. It's not down at all. So as a percent of the total market, iBuyers are down. They're only 1% in June in Phoenix. So the market has recovered quickly. The iBuyers have not followed suit at the same velocity. So they're hesitant. They're waiting. They're going slow. It makes tons of sense, but we shouldn't think that all the iBuyers are kind of back to normal and we're starting to purchase houses just like we were before. So that whole section there was about surviving the pandemic. This is about what happens when you pause and you get back to it. It's important to note that once you survive the pandemic, you're still stuck with a difficult loss-making business. Zillow makes all their numbers public, so I'll pick on them for a minute. But Zillow was losing $100 million a quarter. It actually went down, so they kind of flattened the curve in Q1 2020. But that's a huge loss, right? This is hundreds of millions of dollars in a year. So if everything went back to normal and iBuying fully recovered and was at the same volumes, you'd be back to a business that was still losing hundreds of millions of dollars a year. So the iBuyers still have that problem to contend with, right? And Zillow in particular, that net loss per home, it's decreasing, it's getting better, but it's still high. So you still have these fundamental economic issues of how do we lose less money on each home? And one of the big areas, the big kind of battlegrounds for 2020, as it were, and probably 2021, is going to be in those adjacent ancillary services. So last year in 2019, the two biggest iBuyers, Opendoor and Zillow, they launched ancillary services. So Zillow launched their home loan service, Opendoor launched their home loan service, Opendoor bought a title company, Zillow launched a title company. That was all in the span of 6-7 months. Clear intent, like, hey, we need to make money somehow. Let's launch these ancillary services. If we can get people to start using our mortgage business or title business, then our net margins are going to go from negative to positive in that regard. So I think that's still kind of a big issue here that all these companies are going to face, is how do we make money? And then the last bit here, and this is where a lot of interesting activity has occurred, is this further integration with the traditional industry. This is probably my favorite chart. I kind of keep using this for the past couple of years, but it's gone from an either or to an and. It's not iBuying or disruptors or the traditional industry. What's really happening, and I've said it before, and it's true, and it will continue to happen, is this meshing, this blurring of the lines between iBuying and traditional industry. It's not an either or, it's an and. They're all together, and they're both moving towards each other. It's not just iBuyers coming in, it's the traditional industry adapting. So what's happened in that space? I think the biggest move is that Opendoor and OfferPad, the two biggest pure play iBuyers, have launched traditional listing services. They've launched traditional brokerage services. So this is, if you go to Opendoor's website, this is what you'll see. You can either sell them your home instantly and pay that fee, or you can have them list your home, just like a real estate agent would. And it's a discounted fee, so you pay just 5% in fees. I don't know where we got this traditional 6%. It basically traditional is kind of 5.5%, I think is the latest numbers. But anyway, it's discounted. They'll list your home for sale, right? That's huge. I mean, when the iBuyers started 4, 5, 6 years ago, their big value prop was, don't use an agent. Don't put your home on the market with all that uncertainty about when is it going to sell, what price is it going to sell. Don't worry about having open homes and people kind of tramping through your home that you don't know. Just sell it to us. It'll happen like that. We'll write you a check and then you're done. Now what they're saying is, or we can also do all that other stuff too. It makes sense from a business perspective, right? Because for every 100 customers that end up going to Opendoor, Zillow, or OfferPad, those companies only buy, I don't know, say 10, 15% of those houses. Imagine having a coffee shop where you can only serve 10% of the people that came in your front door, right? You want to serve everybody who comes in. You're spending millions and millions of dollars to acquire customers. You don't want to say no. You want to say yes. So that's really what's happening here. These companies want to say yes. Like, yeah, if you found us and you want to work with us somehow, like, we'll help you. No matter what you want, we'll give you those options. The big question on this is, who are the agents they're working with? Yeah, I think there's two options, right? You can either have in-house salaried agents, kind of the Redfin model. And that's what OfferPad's doing. And I believe Opendoor is testing that model out. And then you have agent partners, right? Where you kind of partner with existing agents and brokers in a market. It's my understanding OfferPad's not doing that. Opendoor is testing that out as well. And that's very similar to what Zillow's doing with their Premier Agent program, right? When they get somebody who wants to sell traditionally, they send it to a partner. So you either partner or you bring it all in-house. Those are the two options. I think if you want to make a lot of money with ancillary services and mortgage and title, it makes sense to bring it in-house. You have higher attach rates, you have more control over the transaction, there's a better consumer experience. So we'll see where that kind of evolves over the next couple of years, but that's where we're at right now. The other big thing that happened just kind of quietly a week or two ago, OfferPad increased their agent referral fee from 1% to 3%. So typically for the iBuyers, if you're an agent and you're representing a customer and you want to get them an iBuyer offer, the iBuyers will give you kind of a 1% referral fee. OfferPad pumped that up to 3%, which is kind of what they would normally get if they were just listing the house. It's interesting move. One can imagine, it is an effort to get more agents using this system. So again, a lot of activity and blurring of the lines between those two industries. Other big news, last week, Opendoor partnered with Realtor.com, kind of finally. This was, waiting to see what happened here. So Realtor.com, the second largest portal behind Zillow, and they launched the seller dashboard or seller something or other, where you can, if you want to sell your home, you go there, you enter your address, answer some quick answers on your house, and then they give you options to sell it. So Opendoor is the iBuyer option, Easy Knock is the another option, and there's some other ones, WeBuyHouses.com. I'm not sure. It's kind of 3 or 4 different options. It's interesting because I think this was it really just demonstrates the power of the real estate portals at the top of the funnel. They have customer eyeballs. That's what everybody else needs. That's what Opendoor needs. Easy Knock, all these companies, they need customers. They need a way to acquire them. This is a way to kind of bring that together. It's, I went through it, and I mean, good on these companies for launching this. I'd say the integration, and I think the folks at Opendoor would agree, the integration is not ideal. I went through, I entered information on Realtor.com, clicked a button, then I went over to Opendoor and nothing transferred over, and I had to kind of start over again, right? But it's a start, and it demonstrates intent and the direction these companies want to go in. So we're going to see more and more of this pushing together. Oh, here's again another screenshot from that. If you're on Realtor.com and you go through, it's kind of giving you an estimated range, and you can request a quote. So different, I'd say the Zillow experience is very integrated. It's all in one form. This is more of a kind of a marketplace. We're going to send you out different places, and I think there's pros and cons to each method there. So I'll keep tracking this. We'll see what happens over time, but it does signal the intent of trying to do more, give consumers as many options as possible, showing the power of the portals like Realtor.com in terms of having all those eyeballs, and showing how valuable those leads are to a company like Opendoor. And then the last thing in terms of these, kind of things coming together, the two worlds, traditional iBuyers, continuing to see the traditional brokerages moving closer to iBuyers, launching those services. So there's a number of brokerages that have launched, traditional brokerages that have launched their own iBuying services. They're in markets where the iBuyers are not, or not yet. And they're saying, yeah, we'll buy your house. Imagine a billboard for your local broker. Like, we'll give you an offer in 24 hours. That's great. You're going to get phone calls, and maybe you buy a couple houses a month. But the point is, you're getting phone calls. You're getting people who are interested in. It's a great lead gen opportunity. So I'm seeing brokers do that. I'm also seeing companies like Metro Brokers down in Atlanta, continuing to partner with the existing iBuyers, but doing it in such a way where they're offering these branded solutions. Metro Move, Instant Move. The iBuyer behind an Instant Move is still Opendoor and Zillow, but it's packaged up inside a local trusted brokerage with thousands of agents in the field. So this is not a this game of disruption and iBuying and changing how people buy and sell houses. It's not the exclusive domain of these disruptors. A lot of smart brokers and agents are co-opting those best ideas, and they're making them their own, and they're offering them to great success. So it really does go both ways. Right, so the two circles coming together. So I thought I'd end today with just a couple of closing thoughts. If I kind of sit back in my hotel room and think, what's happening in the industry, and what does all this say? If I had a 30-second elevator ride to talk to somebody, how would I sum up what's happening here? There's really two thoughts. The first is this: disruptors are here to stay. I think maybe a lot of people were thinking / hoping that with the pandemic, all these companies with unsustainable business models would just kind of go away. It's not the case. There's a lot of venture capital. There's probably more venture capital than there is good ideas. It's still getting invested in these companies. They've all raised money, so they're not going anywhere. And in fact, they're kind of rigorously adjusting their business models. They're not sitting still. They're not just pouring good money after bad. They're not reinvesting in something that doesn't work. They're moving around and adjusting those business models to find things that do work, where they can make money. And we're seeing a lot of that activity. I think we saw it a bit in the early days of the pandemic, but now in the past month, 4 to 6 weeks, seeing more and more of it. And I expect that to pick up. Then the second thing, in terms of just the real estate market in general, and this is especially true in market like the U.S. and a lot of European markets. I'm not sure if it's going to play out here in New Zealand quite the same way, but the pie is getting smaller. There will be less real estate transactions this year than last year. Like you can't get around that fact. So it's like a game of musical chairs. We've had 100 chairs in this game for a while, and now 20 of them have been taken away. There'll be less commissions. There'll be less commissions going to agents. There'll be less commissions going to brokers. There'll be less money spent on other technology and tools. I mean, you can't get away from that fact. So if the pie is getting smaller, it really is a game of survival of the fittest. Not everybody's going to have a chair. Not everybody's going to be able to stay in business. And this may take months and months and months to fully play out. But it's going to be the agents, the brokers, the disruptors, the real estate tech companies, those that have the strongest balance sheet, that can move fast, that are agile, and that can respond to consumer needs as fast as possible. Those are going to be the ones that survive, do a best job at meeting those consumer needs. As opposed to other folks that they sit back, they can't move as fast, they can't invest, they can't make decisions quickly, or they're unwilling to adapt or change. That truly is survival of the fittest. So that's kind of where we are. Well, hey, that is it for me today. I hope you enjoyed it. It was fun getting on and chatting with everybody. I'll make a recording of this available, and hope everyone has a good day, and I'm sure we'll talk soon. Cheers.